They say you should never discuss politics or religion at the dinner table, and as a private investor, I have often tried to keep politics away from my portfolio. But the reality is, politics dictates the tax code, and the tax code dictates investor behaviour. You simply cannot separate the two. Welcome to this pilot episode of a brand new bite-sized offering from the Desert Island Investor. We call this Market Tides and Trade Winds. The goal here is simple: wider scope, shorter format, and a direct look at the recent news headlines shaping our world as private investors. And today, we need to talk about the storm brewing at the intersection of UK social care, inheritance tax, and the junior stock market. Our new Prime Minister frequently speaks about the critical state of social care in the UK. For him, it's deeply personal. His own father, like hundreds of thousands of people across the country, is sadly living with dementia. It's an emotional and financial minefield. I was catching up with a close friend recently who watched his own father spend roughly £350,000 in care home fees. Think about that number for a second. £350,000. Gone. Meanwhile, some of the other residents in that exact same facility paid absolutely nothing. Why? Because they either had no assets to begin with, or their savings fell below the government threshold. My friend was so shaken by this experience that he has completely restructured his wealth, placing his assets into a trust. He refused to let a lifetime of hard work be completely swallowed by a system that feels to him like it punishes those who've saved. And that brings us to the core issue: how our government views wealth preservation. Look at what has happened to the UK tax landscape recently. Standard inheritance tax sits at a bruising 40%. Our previous Chancellor pulled pension pots directly into that IHT net. Private business owners are now facing a 20% effective tax rate above their allowances, a change that could easily force families to liquidate or sell off companies just to pay HMRC, throwing employees out of work in the process. Even the famous non-dom status was dismantled, replaced by strict residency rule. Spend 10 of the last 20 years here and the UK global tax net snaps shut around them. When you tighten the screws this hard, you have to factor in human psychology. In economics, very few things increase in consumption when you raise the tax on them. We saw it when they hiked employer national insurance contributions. It didn't magically create revenue, it functioned exactly as I predicted, as a tax on jobs. So what do wealthy individuals do? They pack their bags. They relocate to more benign tax environments. And ironically, the total tax take for the government actually shrinks. But here is where it gets fascinating. The Prime Minister has previously floated a radical alternative, replacing inheritance tax entirely with a universal social care levy. Now currently IHT isn't ring-fenced, it just goes into a giant generic treasury pot alongside everything else. The PM pitched the idea of a 10% levy with no allowances. Let's look at the math. If your estate is worth £20,000, you pay £2,000. If it's worth £1 million, you pay £100,000. On paper, a flat 10% tax sounds incredibly appetising compared to a 40% headline IHT rate. For many high net worth individuals, 10% might be an acceptable price to pay for peace of mind. It might even stop people from fleeing overseas or convince expats to bring their capital back to the UK. It feels fair because everyone pays something, and your long-term elderly care is entirely funded by the state with no hidden ceiling. Of course, critics will argue true fairness requires a progressive system, where the richer you are, the higher your percentage rate is. But let's bring this back to our world, the world of investing, and specifically my portfolio. For years, the alternative investment market, the AIM market, enjoyed a massive structural advantage. If you held certain AIM shares for 2 years, they were broadly exempt from IHT. It was an artificial life support system designed to pump liquidity into smaller, high-risk UK growth companies. Recently, the government had that relief, exposing AIM shares to an effective 20% tax rate that already damaged their appeal. But think about the domino effect if the government actually goes through with a 10% flat social care levy. If standard 40% IHT is abolished, the tax incentive to hold AIM shares falls to exactly zero. Think about it. If an investor faces a flat 10% tax on their estate regardless of what they own, why on earth will they take on the extreme volatility and liquidity risks of junior AIM mining or tech stocks? They wouldn't. They would reallocate their capital into safer, liquid, global blue chips or cash. If that levy ever becomes reality, it will not enhance AIM share prices. In fact, it could trigger a structural mass exodus from the UK's junior market. It's just a little something that has been occupying my thoughts lately, given my exposure to AIM. The tides are shifting, and as private investors, we have to make sure we aren't caught swimming against the wind. That's some food for thought for this pilot episode. If you enjoyed this shorter format, please hit the like button and subscribe to the channel and leave a review. It really helps a new offering like this find its audience. Until next time, happy investing.
Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. Thanks again for listening. See you next time.